Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of these corporate filings. Today we're cracking open T1 Energy's latest report. You know, it's like reading a novel, except the ending is probably a financial restructuring. Before we get into that, are they thriving or barely surviving? This report has got some interesting answers, so stay tuned. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Jump in when you can. Alright, so we're looking at their report for the first 3 months of 2025 ending in March. And the first thing to note is they changed their name from Freer Battery to T1 Energy in February of 2025. So just keep that in mind as we go through this. Okay, let's dive into the numbers. First, the balance sheet. Looking at their assets, cash and equivalents are down to about $49 million from $73 million at the end of last year. That's a pretty big drop, showing they're burning through cash. But there's also a huge jump in receivables, money owed to them from related parties, to 18 million, while last year it was zero. So basically they are lending 18 million to partners. We will see if that gets paid back. Inventory has also jumped significantly to $33 million, up from $275 million, which is good. It means they are building products. Moving to the other side, what do they owe? Accounts payable, what they owe to their suppliers, nearly doubled to $109 million from $62 million at the end of last year. That could mean they are taking longer to pay their bills, or that they have significantly ramped up production. Looking at the overall picture of the balance sheet, the total assets increased, meaning overall the change is positive. Total equity went up as well, so nothing fundamentally wrong, although the burn rate, cash burn, is a bit worrying. Now let's check out the income statement, how much money they are making. They had sales of $64.6 million. Sounds good, right? There's a catch. Those sales were with related parties. In other words, with companies they are affiliated with. Without external sales, it is hard to tell if it is real business or just an accounting trick. For comparison, last year they had no sales. Now the cost of sales was about $35.7 million. And that means a gross profit of $29 million. And that means a gross profit of $29 million. Now comes the interesting part. Their selling, general and administrative expenses, which are overhead, came in at a whopping $52.6 million compared to only $15 million a year ago. They are burning through so much cash so quick. That brought their loss from operations to $23.6 million. Not good. The business is losing money, but other things brought the net loss down. They have something called derivative liabilities, fair value adjustment of positive $25 million. The number is huge and basically means if their financial situation changed, they would owe way more. After everything is factored in, including some income tax benefit, the net loss comes down to $49 million. And from discontinued operations, which we will talk about soon, negative 12 to 1. Once added up, the net loss is $16.20 million or 11 cents per share. Last year it was way worse, 20 cents per share. We can only hope things improve and the losses stop. Let's take a quick look at the cash flow statement to see how much actual cash is flowing in and out. Operating activities used $44.8 million in cash. Basically, while the income statement looks bad, cash flow is the real measure of how bad after investing activities, which is where they make bigger moves, brought in $22 million finally. So financing activities cost them $3.7 million, ending up with $51 million in cash. Time to decode the notes. The first interesting piece is on inventory. At the end of March, they had $13 million in raw materials. Basically, that means they are hoarding it, planning to produce it later and sell it. Also, they had almost $100 million in finished goods ready for sales. It is good that they have sales, inventory, production. It makes the company feel more real. Looking at their property and equipment, they have around $315 million in value. Most is leasehold improvements and machinery, so factories and such. They also had only $750K construction. That's basically nothing, so they aren't building much new factories right now. They already built them. Let's peek at what they owe. Their biggest bill is $56 million in accrued purchases. Sounds like materials they bought on credit. Moving on, what about the debt? They're sitting on a pile of debt, over $600 million. A lot of it is from Trina, their related company. Some with banks are interest rates due of around 7%. Let's scroll and see what their schedule is when it is due. $98 million is due this year. They should be able to pay it, but we will see what their plan is in 3 months. Okay, this is where things get a little, shall we say, creative. We have something called level 3 fair value instruments. Basically, they are guessing the value of something with limited or no market data. So they have one called the Anti-Dilution Right, a Share Purchase Agreement, and a Private Warrant Agreement, all sitting at level 3 and totaling a couple of million. It has to do with them being tricky to value and the value swinging wildly. It will depend on their actions and stock price, but can become a very real liability and problem. How many shares are available? The company has about 355 million shares authorized, with around 155 million issued and outstanding. They have a complicated tax situation, but overall tax is what you would expect. It sounds like they are selling a lot, if not all, their product to Trina Group, which sounds a bit like selling to yourself rather than having a real business. We will see how that develops. Finally, they sold some previous businesses, one of them in Georgia and the other in Europe. They made about 50 million from it, but they have to repay the government some funds. Now, let's take a step back and look at T1 Energy as a whole. It's a company in transition, fresh off a major acquisition and name change. They're building a solar module manufacturing business in the US, which is a good sector to be in sector B in certain US, which is a good sector to be in SAC now. On the flip side, they are making sales, building inventory, building factories, getting partners, which means it is very real. One thing to worry about is the lack of diversification, as their revenue is heavily dependent on sales with related parties. Overall, I think it will be a good long-term bet, but they have some serious short-term issues that they need to fix. Alright, that's our breakdown of T1 Energy's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.